Disclaimer.
Right now, as you're watching this, silver is getting absolutely demolished. We're talking about a 74.16 price tag after a brutal 4.75% drop in a single trading session on January 8th, 2026. This isn't some abstract market movement happening in the background of your financial life. This is the second consecutive day of massacre, and the selling pressure isn't even close to being finished. Before we dive into what's really happening behind this crash, if you appreciate this kind of investigative financial content that connects the dots between market manipulation and real opportunities for everyday Americans, please hit that like button and subscribe to the channel. Your support allows me to continue this mission of uncovering the patterns that mainstream financial media won't touch, and it helps me produce even more high-quality analysis that puts the truth in your hands. Now let's get into what's really going on. Here's what should grab your attention. While you're seeing this crash play out on your screen, billions of dollars in futures contracts are being mechanically dumped into the market. Not because of fundamentals, not because industrial demand suddenly disappeared, but because commodity index funds are being forced to rebalance their portfolios over the next several days, and silver's incredible 180% rally throughout 2025 has now become a weapon being used against it. Think about the irony for a moment. Silver climbed from 29 in January 2025 all the way to 84 by late December 2025. One of the most explosive moves in commodity history. Investors who got in early doubled, then tripled their money. But now that very success is triggering algorithmic selling that has nothing to do with whether silver is valuable or not. These passive funds don't care about supply shortages or industrial demand. They simply must dump futures to meet new index weightings, regardless of what's actually happening in the real world. Let me put this in perspective with a timeline you need to understand. Between December 26th and December 30th, 2025, the CME Group delivered a 1-2 punch that set up today's carnage. They raised margin requirements by a staggering 47%, jumping from $22,000 to $32,500 per contract. That happened right as silver was testing $84, its highest level in decades. According to CME's own regulatory filings, this was supposedly about market volatility management. But here's what it really meant for traders. If you were holding silver futures on leverage, you suddenly needed to come up with an additional $2,500 per contract or face forced liquidation. Now, just over a week later, we're watching the second wave hit. The index rebalancing creates another round of forced selling. And it's happening right now as you're listening to this. These aren't weak hands panicking. These are mathematical requirements playing out across billions of dollars in managed funds. The algorithms don't sleep, don't negotiate, and don't care that they're creating a once-in-a-decade buying opportunity for anyone paying attention. But here's where this gets really interesting, and where you need to understand the disconnect that's creating extreme opportunity for regular Americans willing to think independently. While paper silver futures are showing $74.16 on COMEX, physical silver premiums in Shanghai are still commanding more than $80 per ounce. Let me repeat that, because it is crucial. The actual metal that you can hold in your hand, the stuff that goes into solar panels and electric vehicles and circuit boards, is trading at a completely different price than the paper contracts being dumped by index funds in New York. According to data from the Shanghai Gold Exchange, physical dealers in China are paying significant premiums over the spot price because they know what Western paper traders are ignoring. There simply is not enough physical silver available to meet industrial demand at these artificially suppressed prices. American dealers are reporting the same phenomenon. Walk into any reputable bullion dealer today, and you'll find thin inventory at elevated premiums far above that $74 COMEX price. Think about what this means for your investment decisions. The Federal Reserve's upcoming rate decision, with market data showing a 90% probability they'll hold rates steady, has removed the immediate catalyst that was driving silver higher in late 2025. That gave the index rebalancing algorithms the perfect environment to execute their mechanical selling without fighting against fresh speculative buying. But this manufactured weakness is creating exactly the kind of opportunity that Goldman Sachs is privately telling their wealthy clients to exploit before the second quarter industrial panic hits. You might be wondering how I know what Goldman is telling their private wealth clients. Because while their public commodity desk was putting out cautious research notes in late December, their private wealth management division was sending very different messages. Several reports from financial advisors have surfaced showing Goldman quietly recommending that high net worth individuals use this exact kind of volatility to accumulate physical silver positions. They understand something that the algorithmic index funds don't, the difference between paper price and physical reality. Here's the setup that's visible right now, happening in real time, as these index funds continue their rebalancing through mid-January. Every contract they dump creates downward pressure on the COMEX price. Every COMEX price drop makes retail investors nervous. Every nervous investor who sells thinking the rally is over is handing physical metal to buyers who understand that this disconnect cannot last. Let me give you a concrete scenario that shows why this matters to your portfolio. Imagine you bought silver at $60 during the summer 2025 rally. You watched it climb to $84 by December, feeling pretty good about that 40% gain. Then the margin hike happened, and now today's crash has you sitting at $74, wondering if you should cut your losses before it drops further. That anxiety is exactly what this manipulation relies on. The paper market is designed to shake out retail investors through volatility, while institutional buyers and foreign central banks quietly accumulate the physical metal at discount prices. According to the World Gold Council's latest precious metals survey, central banks globally increased their precious metals diversification in the second half of 2025, with silver gaining attention as a strategic industrial commodity beyond its monetary role. That is not speculative money. That's sovereign wealth looking at long-term supply-demand fundamentals that don't change just because index funds need to rebalance. The Bank for International Settlements data shows us something equally revealing. The paper-to-physical leverage ratio in silver markets has reached extremes not seen since right before previous major squeezes. When that ratio gets too stretched, when too many paper claims exist for too little actual metal, the market has historically snapped back violently. And it always happens when retail investors least expect it, right after a scary correction that convinces regular people to sell. So here's what you're watching unfold on January 8th, 2026. This isn't the beginning of a collapse. This is the final washout before the real move begins. The index rebalancing will finish over the next several days. The mechanical selling will complete. The margin hike impact will be fully absorbed. And then the market will have to confront a reality that paper algorithms cannot change. There simply is not enough physical silver to meet industrial demand at these prices, and China just made that problem exponentially worse 7 days ago. Your decision point is right now, today. While others are panicking over red numbers on screens, are you going to understand that paper price manipulation and physical reality are two completely different things? Because the buyers who recognize this disconnect, the ones willing to look past today's bloodbath and see the supply crisis building underneath, are the ones who will be positioned for what's coming next. While everyone's focused on today's price crash, something far more significant started happening 8 days ago that almost nobody is talking about. On January 1st, 2026, China flipped a switch that fundamentally altered the global silver supply chain, and we're only beginning to see the consequences play out in real time. Here's what changed. China implemented an export licensing system that requires any company wanting to export silver to meet two brutal requirements: an 80-ton minimum shipment size and a $30 million credit facility. Think about what that means for a moment. China controls between 60% and 70% of the world's silver supply, and they just eliminated hundreds of smaller exporters from the market with the stroke of a pen. When Elon Musk tweeted on December 28, 2025, that this is not good in response to these new Chinese export restrictions, most people thought he was being dramatic. But now, 8 days into this new reality, his warning is proving prophetic in ways that should terrify anyone relying on stable silver supply chains. The physical metal is literally seizing up in Chinese warehouses while the paper price collapses in New York. Let me walk you through exactly how this licensing system works and why it's so devastating. According to official announcements from China's Ministry of Commerce, any exporter now needs to demonstrate they can handle 80-ton minimum shipments. That's roughly 2.5 million ounces per shipment. For context, many regional exporters who previously supplied silver to manufacturers across Asia were handling shipments of 10 to 30 tons. They've been completely cut out of the market overnight, but the credit requirement is even more restrictive. A $30 million credit facility means you need serious banking relationships and balance sheet strength. Small and medium-sized trading companies that have been moving Chinese silver to global markets for decades simply don't have access to that kind of credit. The result is a massive consolidation where only a handful of state-connected enterprises can export silver from the country that produces and refines the majority of the world's supply. You might be wondering why China would do this right now. Think about what's happening in the global economy. We're in the middle of the largest energy transition in human history, and silver is the critical material that makes it all possible. Every solar panel, every electric vehicle, every data center for artificial intelligence, they all require silver in quantities that cannot be substituted or reduced without sacrificing performance. The industrial demand numbers tell a story that's impossible to ignore. According to the Silver Institute's latest World Silver Survey, global industrial demand hit 680.5 million ounces in 2024, an all-time record. But here's what should really get your attention. That number is accelerating, not plateauing. Solar installations reached new highs in 2025, with China alone installing more capacity than the entire rest of the world combined during the first half of the year. Let me give you some concrete numbers that show where this demand is coming from. Electric vehicle production is projected to grow 30% in 2026, reaching 116 million units globally. Each EV requires between 25 and 50 grams of silver, depending on the model and battery configuration. Do the math on that, and you're looking at an additional 2,900 to 5,800 tons of silver demand just from the automotive sector in a single year. But it gets more intense when you look at solar technology evolution. The new TOPCon and SHJ solar cell designs that are becoming industry standard use between 50% and 100% more silver per panel than the old PERC cells they are replacing. According to research from the International Energy Agency, this technology shift is happening precisely as global solar installation targets are doubling to meet climate commitments. Every attempt by manufacturers to thrift silver usage by making thinner connections or using less paste per cell is being completely overwhelmed by the explosion in volume. Think about the timing trap that's being set right now. While index funds are mechanically dumping futures contracts on January 8th through mid-January because of rebalancing requirements, Chinese buyers are scooping up physical silver at these artificially suppressed prices. They understand something that Western paper traders don't once their licensing system fully takes effect and supply chains adjust to the new reality. The metal simply won't be available at any COMEX price that makes sense. Here's where our supply situation gets truly concerning. COMEX inventories are sitting at roughly 30 to 45 days of supply based on current industrial consumption rates. That might sound like a reasonable buffer until you realize that's total inventory, not just deliverable stock. London vaults, which serve as the global physical trading hub, are down 40% from their recent peaks. Shanghai gold exchange warehouses are at decade lows. This isn't a regional shortage. This is a coordinated drawdown happening simultaneously across all major storage facilities. According to data from CPM Group, one of the most respected precious metals research firms, the deficit between annual silver production and total demand has now persisted for 5 consecutive years. We're mining and recycling about 1 billion ounces per year, but we're consuming about 1.2 to 3 billion ounces when you add up all industrial investment and jewelry demand. That 230 million ounce annual deficit has to come from somewhere, and it's been coming from above ground stockpiles that are now running critically low. Let me paint you a picture of what's happening in the supply chain right now, 8 days into China's export stranglehold. Manufacturers who plan to purchase silver in Q1 2026 at lower prices after the December correction are finding that their usual suppliers in China simply cannot fulfill orders under the new licensing regime. The small and mid-sized exporters they have worked with for years are now locked out of the export market. The large state-connected enterprises that can export are prioritizing Chinese domestic manufacturers who are also competing for the same limited supply. Japanese electronics manufacturers, according to reports from trade publications, are already paying premiums of 15% to 20% over spot prices to secure physical delivery. South Korean solar panel producers are experiencing similar pain. European automotive suppliers are quietly scrambling to lock in supply agreements before the situation gets worse. And here's the kicker. All of this is happening while the COMEX paper price is crashing because index funds are rebalancing. Think about what this means for American companies in the solar and EV sectors. We have massive federal incentives pushing clean energy adoption and domestic manufacturing. The Inflation Reduction Act created billions in tax credits specifically to build out our solar and battery production capacity. But none of that matters if you can't get the silver you need to actually manufacture the products. Chinese export restrictions aren't just affecting Chinese companies, they're creating a supply crisis for every Western manufacturer who relied on that 60% to 70% of global supply flowing freely. The data center build-out for artificial intelligence adds another layer of unstoppable demand. According to Goldman Sachs infrastructure research, data centers require massive amounts of silver in electrical components, connectors, and thermal management systems. As AI training and inference capacity expands globally, each new facility represents silver demand that cannot be postponed or reduced. These aren't consumer discretionary purchases that can wait. This is infrastructure that companies like Microsoft, Amazon, and Google are racing to build because the competitive dynamics of AI give them no choice. Here's the reality check that should be sinking in right now. We're watching a historic disconnect play out in real time. Paper silver futures are being mechanically sold by algorithms that don't care about physical supply chains. But 8 days into China's new export regime, the actual metal that manufacturers desperately need is becoming increasingly difficult to source at any price. When Western industrial buyers wake up in Q2 2026 and realize that Chinese silver simply isn't flowing the way it used to, when they understand that their just-in-time supply chains are about to break down, the panic buying into a market with 30-day inventory levels is going to move prices in ways that make today's 4.75% drop look like a rounding error. Your portfolio decision today is being made against the backdrop of a supply crisis that is already underway, but hasn't been fully priced into markets yet. While others are selling into the index, rebalancing weakness, are you paying attention to the fact that China just weaponized control over 60% of global silver supply at exactly the moment when industrial demand became non-negotiable for the energy transition? Now let's talk about where this is actually heading. Because Bank of America didn't pull their $130 to $309 price range out of thin air, this isn't some optimistic speculation from precious metals enthusiasts. This is mathematical inevitability playing out in slow motion, and today's crash to $74 is simply the final discount opportunity before the mechanism breaks. Here's the math that should keep you up at night if you're thinking about selling. We have a 230 million ounce annual deficit that's now persisted for 5 consecutive years. That's not a temporary imbalance, that's a structural supply shortage that has been eating away at above ground inventories, while everyone assumed the paper market could just keep creating contracts indefinitely. China just eliminated 40% to 50% of export supply with their January 1st licensing requirements. And according to the latest data from the London Bullion Market Association, the paper to physical leverage ratio has reached 356 to 1. Let me put that leverage ratio in terms you can visualize. For every actual ounce of physical silver that exists in deliverable form, there are 356 paper claims against it. Think about what happens when even a small percentage of those paper contract holders decide they want actual delivery instead of just cash settlement. The system doesn't have the physical metal to deliver, and when that reality becomes undeniable, prices don't adjust gradually. They explode violently as the paper market loses all credibility. The question isn't if this breaks, the question is when. And historical precedent gives us a pretty clear timeline that should have your attention focused on the March through June 2026 window. When exchanges raise margin requirements, the way CME did in late December, it typically takes 3 to 6 months for the forced liquidations to complete for weak hands to finish selling, and for the smart money to finish accumulating before the real move begins. You've seen this pattern before, even if you didn't recognize it at the time. In 1980, silver saw a 50% correction that shook out retail investors right before it went on a 10x move that made early buyers generational wealth. In 2011, we saw a similar violent correction that convinced everyone the rally was over right before silver pushed to $50. The difference now is that those historical episodes didn't have China weaponizing 60% of global supply, didn't have 356 to 1 paper leverage, and didn't have industrial demand that's literally non-negotiable for the energy transition that every major economy has committed to. Let me walk you through what's about to happen between February and April 2026, and why today's price of $74 will look like an absolute gift in hindsight. Right now, solar manufacturers are delaying purchases because they expect prices to drop further. They're looking at today's crash and thinking they'll wait for $65 or $60 before locking in supply. EV battery producers are running lean inventories, confident they can source silver just in time when they need it. Data center developers are assuming their suppliers will deliver on schedule. But here's what changes when the calendar turns to February and March. Those solar manufacturers will start running production schedules for Q2 and Q3 installations. They'll reach out to their usual Chinese suppliers and discover that the companies I've worked with for years can no longer export because they don't meet the 80-ton minimum or the 30 million credit requirement. The few large state enterprises that can export will be prioritizing Chinese domestic demand, which is exploding as their own solar and EV industries ramp up. According to supply chain analysts at Wood Mackenzie, the typical procurement lead time for industrial silver users is running about 90 to 120 days from order to delivery. That means decisions being made in February and March determine what's available in May and June. When those procurement officers realize that Chinese silver isn't flowing the way it used to, when they understand that their just-in-time supply chains are about to break down, the panic buying begins. Think about what happens when just one major solar manufacturer decides they need to secure 6 months of supply immediately instead of buying month to month. We're talking about orders for millions of ounces hitting a market that has 30 to 45 days of total COMEX inventory. A single large order could move the price $10 to $20 in a day. Now imagine multiple manufacturers across solar, EV, and electronics sectors all reaching the same conclusion simultaneously. The AI data center build-out adds another layer of time-sensitive demand that cannot wait. Microsoft, Google, Amazon, and their competitors are in a race to build computational capacity, and every day of delay means falling behind in the AI arms race. According to their public infrastructure investment announcements, these companies have committed hundreds of billions of dollars to data center construction over the next 24 months. They're not going to let a silver shortage derail projects that determine their competitive position in the most important technology shift of our lifetime. Here's your decision point, and it's happening right now on January 8th, 2026, while that $74 price flashes on your screen. Silver climbed from 29 in January 2025 to 84 by December 2025. If you bought anywhere above 74 during that rally, you're feeling pain today. You're wondering if you should cut your losses before it drops to $65 or $60. That anxiety, that fear of watching your gains evaporate or your losses grow, is exactly what this paper market manipulation relies on, to shake out retail investors before the real move begins. But let me give you some perspective from someone who has studied every major precious metals move in modern history. The investors who made life-changing returns weren't the ones who sold during scary corrections. They were the ones who understood the difference between paper price manipulation and physical supply-demand fundamentals. They were the ones who recognized that temporary volatility created by index rebalancing and margin hikes was actually the opportunity, not the warning sign. You need to ask yourself a fundamental question about the silver in your portfolio or the silver you're thinking about buying at these levels. Do you believe that the global energy transition is real? Do you believe that solar installations, electric vehicles, and AI infrastructure are going to continue growing? Do you believe that China's export restrictions are actually eliminating 40% to 50% of supply from the market? And do you believe that a 356-to-1 paper leverage ratio is sustainable when industrial users need physical delivery, not cash-settled contracts? If you answer yes to those questions, then today's crash is not a reason to sell. It's the last chance to position yourself before the mathematical reality overwhelms the paper manipulation. According to precious metals strategists at Incrementum AG, who published the annual In Gold We Trust report that institutional investors rely on, silver is setting up for what they call a monetary and industrial perfect storm, where investment demand and industrial necessity converge to create price moves that exceed anything we've seen in decades. The Bank of America price range of $135 to $309 isn't a wild guess. It's what happens when you model a market with structural deficits, supply restrictions, and leverage ratios that have historically preceded violent short squeezes. The lower end of that range, 135s, represents roughly a doubling from current levels and would simply bring silver back to its inflation-adjusted highs from previous cycles. The upper end, $309, is what happens if the paper market actually breaks and price has to rise high enough to either ration industrial demand or incentivize massive new mining supply that takes years to bring online. Here's what separates this moment from every other precious metals rally you've seen in your lifetime. In the past, silver price spikes were driven by investment speculation or monetary concerns. The 1980 Hunt Brothers squeeze was pure speculation. The 2011 move to $50 was driven by quantitative easing and inflation fears. But this time, underneath all the speculation and monetary dynamics, there's a foundation of industrial demand that's absolutely non-negotiable. You cannot build solar panels without silver. There's no substitute that maintains efficiency. You cannot manufacture EVs without silver in the electrical systems. Copper doesn't conduct well enough for the high-precision applications. You cannot build AI data centers without silver in the countless connectors, switches, and thermal management systems. This isn't jewelry demand that disappears when prices rise. This isn't investment demand that rotates to other assets. This is industrial necessity for technologies that governments and corporations have committed trillions of dollars to deploying. So when you're sitting there today watching silver trade at $74 after that brutal 4.75% drop, after 2 consecutive days of selling pressure, with index rebalancing continuing through mid-January, you have a choice to make. You can focus on the fear, on the red numbers, on the possibility that it drops another 5% or 10% before it turns. Or you can focus on the fact that China eliminated hundreds of exporters from 60% of global supply 8 days ago, that COMEX inventories are at 30 to 45 days of coverage, that industrial demand hit 680 million ounces in 2024 and is accelerating, and that a 356-to-1 paper leverage ratio has never survived intact when physical delivery pressure builds. The investors who will look back on today as the opportunity of a lifetime are the ones who understand that every ounce of physical silver they hold through this manufactured panic is an ounce that won't be available when the Q2 industrial squeeze detonates. They're the ones who recognize that paper price and physical reality are two completely different things, and that the gap between them is about to close in the most spectacular way. Your silver, whether it was in your portfolio right now or whether you're buying at these levels while others panic, represents a bet on mathematical inevitability over algorithmic manipulation. It represents a position in the one commodity that's simultaneously experiencing structural supply deficits, export restrictions from the dominant producer, record industrial demand, and paper market leverage that's completely unsustainable. When those forces converge in the March through June 2026 window that historical precedent points to, the move won't be gradual. It'll be the kind of explosive repricing that creates permanent wealth for those who had the conviction to see it coming. The crash you're watching today isn't the beginning of the end. It's the final shakeout before the inevitable. The question is whether you're going to be among the investors who let fear win or among the ones who understand that today's paper manipulation is tomorrow's missed opportunity.